Hey, good evening, everyone. This is Austin from Life, Love, and the Pursuit of FI.
And this is Greg.
And today we have special guest Ben Bateman. Hey, Ben, how
No,
are you?
Austin.
Awesome. So, Ben, you want to give us a little bit about your background and what you do overall?
Yeah, so a little bit about me. I was in the military for a brief stint. I was a Green Beret. My last job was as a Special Force Officer, a Green Beret. Now I'm doing or trying to get into the multifamily space. And in my free time, in addition to having 4 kids and an amazing wife, I also run a nonprofit helping military veterans and first responders.
Nice. What's the name of the
It's called
nonprofit?
Sportsmen for Warriors. So we primarily use
That's
the
awesome.
outdoors as a healing property or excuse, kind of focus on the fundamentals of enrich, engage, and educate our warrior community.
Was there a specific reason why you founded the nonprofit?
Yeah, I felt that there was a miss. I operate on the premise of it takes a warrior to heal a warrior, and I felt there's a lot of great nonprofits that were out there are doing good things, but a lot of them missed that warrior touch that could really impact and truly change the lives of our warriors. I'm trying to give America back an even better product than and what people get when they transition out of the military.
That's awesome. Do you have any sponsors currently, or if someone wanted to support your nonprofit, how could they go
Yeah,
about
they can
doing
go
that?
to our website, www.sportsmenforwarriors.org, or just Google Sportsmen for Warriors, and they can make donations at any time, or they can contact us, and we can go further into depths and whether they want to do restricted grants or open pot or open donations, and they can do it in memory, memorial, or in honor of veterans or parents, siblings, brothers, or friends.
That's great.
That's
Now,
great.
now you said you were also in multifamily. For those who are listening who might not know, what is
The
multifamily?
multifamily apartment complex, anything bigger than a single family home, i.e., like the house you live in. So whether it's a duplex, triplex, all the way up to 1,000 unit apartment complex, that's what multifamily investing is.
Okay. With getting into multifamily rentals, do you currently have single family homes in your
No,
portfolio?
we just currently have our 2 family homes. One of them's a live-in flip that we're working on. I guess disposing of. We're finishing the construction, the renovations of it as a foreclosure when we bought it. But no, I don't currently own any multifamily at the moment, and we've previously owned single family rentals.
That's awesome. So, what are your overall goals? How many units do you want to
So my
have?
goal's pretty conservative. It's 1,000 units by the time I turn 50, which is in roughly 9 years. Some are 32. But a
That's
lot of
awesome.
people are more aggressive, but for me, having that added time frame, it gives me a chance to actually like not rush into the deal, right? Like I've talked to other people that want to have like 5,000 in 5 years, and I just think every deal they analyze, either they're taking on a big risk with it, and right now the market's not. I think there's opportunities in the market, but you have to seek it out. You have to be the hunter, and I think with a conservative goal, it allows to choose the right properties for the right reasons rather than just rushing to meet a number, right? It's the combination of finding the right property that makes sense for myself and my investors.
Okay. So you mentioned the current environment. Does the current mortgage lending interest rates kind of affect how you're going about buying apartment complexes?
Yeah, I mean, obviously, when you look at the basics of a loan, I mean, it's it's not really much different. It's just a multiple, right? If you buy a single family house for $100,000, what's the impact from say going from where we were a year ago today of a 3.5% interest now to a single family homes at 7%. Now it's just scaling into multifamily in the sense of if you buy 100-unit complex, that impact from that 3.5% to 7% is going to have a substantial impact on the debt service or the mortgage payment required every month. So it changes what you have to do. You have to raise rents. You have to do all those things in order to make the deals actually work.
Okay. You also mentioned that you partner with investors. How do you find like other people who might want to do this?
I find them through social media, find them through other networking opportunities, classmates, connections, family, friends, kind of all the above. And I think a lot of people are more open to real estate in the sense of it's a physical asset versus, say, putting their money in a stock market, which over the last 18 months just felt like a roller coaster. Really, since kind of the fall, November of 21, it's been all over the place, and a tremendous amount of people have seen their 401k substantially reduced in value, and people that are nearing retirement age are now looking back and saying, I don't know if I can retire next year or in 5 years or whenever that goal is. So I think, actually having that physical asset that they can go look at and go see, try to put their hands on, similar to like gold or other physical assets versus just the whims of the stock market.
Okay. So from your time, being in the multifamily space, what would you say is like one of the most important pieces of advice that you have learned thus far in your
I
journey?
think it's be honest with yourself, be honest with other people, right? Like, and humility goes a long way. Ask those hard questions, right? Like if you don't understand something, and find somebody who will answer that question, and find your tribe, find your group of people that are like-minded, that have similar goals or similar backgrounds that will help push you and help you grow to be a better person.
Okay.
And
That's awesome.
I'd say, and I think this goes back to like my construction background of, you never want to hire the guy or the contractor that has a brand new lifted truck. You want to hire the guy that like drives something modest. Except for in the multifamily space, it seems to have private jets and Lamborghinis or Ferraris. That money comes from somewhere. And I'm not against it. Like if that's your thing, like do your thing. But for me, I want to make my investors more money because they are my business family, and I want to make transgenerational wealth for my kids and my kids' kids and their kids, so on down the line.
Yeah, that's awesome. Now, how do you manage your time? You said you run a nonprofit, right? You're doing multifamily. You're also a husband and a father. So how do you kind of manage all of those pieces of your
I
life
think
together?
over my life, I've gotten good at blocking off time and setting times, and it's just finding ways to be efficient, right? Like the first property I underwrote took a lot longer than what it takes me to underwrite properties. And now it kind of gets to the point where just looking at the numbers, looking at the units and the rent, you can kind of figure out whether a property's if it's even worth pursuing, right? When you look at a lot of the properties that are listed on, pick your multifamily, whether it's Crexy or Marks Milchap or any CBRE, whatever. Most of those are overpriced anyways, right? Like they haven't factored in the impact of the change of interest rates. Everybody wants to get kind of that high water 2021, 2022 price, but that's not the environment that we're in.
Okay. For those who might not know, what are some ways that people could become an investor, right? Can people use their
100%.
401ks?
Yes. Yeah, they can use their 401ks. They can use liquid capital. So kind of getting into I'm painting with a broad stroke here, but essentially there's 3 different types. There's joint venture where you go in, you provide money, and you provide some sort of skill set to the team, whether it's general contractor, appraiser, designer, architect, underwriter, capital raiser, whatever. And then you get into 506B and 506C. Now, these are both managed by the Securities and Exchange Commission, or SEC. 506 B is like a friends and family type of package, and it allows non-accredited investors the ability or the opportunity to invest in funds. Now, the constraint on the general partners on a 506B is they can't advertise, so it has to be exclusively like friends and family, classmates, people you served with in the military, coworkers, etc., that you can raise from. 506C is the most restrictive in the sense of people have to be an accredited investor. An accredited investor is a person who has $1 million net worth or assets or an income of $200,000 individually or $300,000 with wife for the last 2 years. And it's required to be verified by a third party person. But yes, 100%. There are opportunities with self-directed IRAs where you can invest as a limited partner or in joint ventures into real estate. So if you're between jobs or you're taking a new job, you left a company and you've got $50,000 or more, and because that's typically what most investment syndicates require, you can, rather than putting that money into your new company's 401k and falling under the restrictions of that fund manager, you can, there's Google self-directed IRA, and there's plenty of good companies out there that allow you that opportunity. And you can do single family investments too. Now, there's a lot of constraints, and I'm not an expert. I'm not a tax expert. I would, contact one of these self-directed IRAs, and a lot of them have like free education where they kind of like show you the ropes and everything that you need to do, and they walk you through. And the fees might be slightly more than your traditional 401k, but the opportunity to invest in an asset that averages 12% up versus, say, investing in the S&P 500, which averages 7.5%. I mean, your money's growing every 5 to 6 years versus every 10 years.
Okay, that's awesome. Now, how do you classify how like well a property is in terms of the condition the property is in, like for
So it's
multifamily?
age, location are kind of the big three, and so it's Class A, B, C, and D. Now, Class A are typically like 10 years old or newer, oftentimes, and then also it factors in luxury items. So like a Class A complex that probably has a swimming pool, probably has a gym, has full time or at least majority of the time staffed. Class B might be 15 years old. It could have those amenities, but maybe it's a little bit further out from the major, let's say, I don't know, San Antonio. It might be an hour outside of San Antonio. It could be Class B. Class C is at least 20 years old. Could be recently renovated or value add, which means it needs renovated. It might not have the amenities, or it could have some of the amenities, but it's not going to have the same features. But with the different classification comes around. Class A, brand new or 5 years old, you're going to pay more money to be in that place. But there's perks of each one. Class C, there are Class D. I've never actually seen a Class D property, so it'd probably be one that's 50 plus years old and probably has no amenities, or might be in a long distance, like 2+ hours from a major metropolitan area.
Okay. Now, for your investment journey and the units that you want to own, is there like a specific range that you're sticking to?
So to get going, I want to do value add on Class C and Class B properties. Focus on Class C to get the kind of the cash flow and the experience, and then I want to expand my portfolio into doing new development.
Okay, you said something that people might not know what that is. Value add.
So
what is that?
On the single family side, it'd be the equivalent of like fix and flip or fix and hold. I like find something, when you figure apartments, there's always wear and tear, right? People move in, people move out. They're short-term tenants, so they're not on it, so they might not take the same amount of care for their property. But something that hasn't been updated in 10 plus years. Sometimes it's been longer, just depending, but we're talking about everything from new paint, new floors, new appliances, to it needs to be taken down to the studs and completely rebuilt. So they almost like become a brand new. The challenge with a lot of the Class C is that there's what you call deferred maintenance, and that's the big stuff that are expectations: boilers, hot water heaters, HVACs, things that don't really add value. They're just an expectation, right? And just like with a home, you would expect that your toilet's flush. Same thing with an apartment. You expect that the heat works or the air conditioning works. And those are just expectations for the operators to maintain, have a crew that services them, and replace them as needed.
Okay. Now, when you kind of analyze and underwrite these deals, are you taking possible maintenance costs into that underwriting?
Yeah. So when you look at the capital expense in order to bring it up to where it needs to be for what the expectations are for that property in that market. And so it's a lot of the times it's carpet, it's flooring, or getting rid of old carpet, replacing with, say, like a luxury vinyl plank, or hardwood or tile, or a combination of those, updating the cabinets, putting new faucets. And in doing those capital expenses, you can also provide opportunities that save money, right? Like low flow toilets and efficiency water heaters, efficiency faucets, all those little things that save the tenants money and save the property owner. Because on the older properties, you might have a 100-unit complex that has one meter, i.e., the owner or the operator of the property might have to allocate expenses or include those expenses like utilities, electricity, gas, water, etc. They might be thrown into the rent, or they might be separate. So those are just opportunities where a person who cares about their tenants. Because the way I look at it, the tenants are just as important to the property as the investors who make it possible. They're the ones that make the payments. They come in and it provides an opportunity. And when you look at going back to kind of the overall market, there seems to be a missing of like starter homes in a lot of places where the 3-bedroom, 2-bath, 1,500 square foot house is too expensive for those young newlyweds or young college graduates to be able to afford to actually buy a house. That they have to go to apartments to save up a down payment, or they have to go to a mobile home to save up to have that down payment, or be able to afford a house for them and their growing family.
Okay. Yeah, no, I absolutely agree. It's definitely harder than it was 10 years ago to be able to buy a house. And I think that's just going to keep getting worse and worse.
Yeah, there's a lot of market demands. In pre-COVID, right, early 2020, the shortage of housing units was somewhere around 3 to 3.5 million, just single family homes or apartment, a single apartment unit. Now the forecast is it's around 6 to 6.5 million, and it's only going to continue to grow as costs go up. As it gets more expensive to build new apartments, it gets more expensive to build multifamily complexes, and then you throw in, everybody loves to go on vacation and stay in a VRBO or Airbnb or whatever, but each home that's a short-term rental, even medium-term rental for like traveling nurses, traveling doctors, that's a place that can be rented or can be used by a potential buyer, right? So it takes one off the market. So as the population grows, as our demand grows, it just gets harder and harder.
Okay. Yeah, no, I agree. And it's just, like you said, it's just going to keep getting harder and harder. Now, you had mentioned having a good team, with like a good general contractor, good investor, stuff like that. And how do you kind of build out a good team?
Yeah, I think step one is you have to start with understanding yourself, right? You have to know your strengths and weaknesses, whether it's your personality, whether it's, there's a lot of different things to kind of figure out, but like knowing what you bring to the table. So if you've never done construction in your life, I wouldn't say that your general contractor or construction side is. Now, if you've got an eye and you can design and you understand color theory and that, then come in and you'd be a good designer, and you can, you think about spaces and you can visualize things. Or if you've done investor relations or accounting, you probably would be good on the fundraising side, or if you know a lot of high net worth people, um, then, or you've done project management, even if it's not necessarily for construction, it's something that you can figure out quickly. And then asset management is like, if say your team now has that 1,000 units, right? You have to have those conversations with the property managers. You have to have those conversations with the general contractors and understand, like, okay, we just acquired this property, now it's ours. Okay, we have whatever time, 18 months, 2 years, 3 years. We have to get everything remodeled. So you have to work with the property managers, come up with a plan of, hey, here's how we're going to execute this, and and then get bids. So it's not complex, and it can be taught to anybody, but it just takes time and experience to get to. So I think when you look at a lot of the troubles that people have probably likely read about in the whether it's Wall Street Journal or Business Insider or even their local papers or on the news about foreclosures in multifamily space, that people get into these properties, they make bad loans in order to make the underwriting, which is the analysis of a property, make it work, and then they might not have. I mean, if you're an IT guy or gal, that that's great, but that doesn't mean that you're going to be able to just jump in instantly and manage a big multi-million-dollar capital expense reinvestment in a property. No, though, I mean, there's unicorns everywhere, and people can do amazing things, but just it gets harder when you have no experience, and as to be bluntly, you can't always smell the BS flag when somebody raises it, right? So
Yeah.
you just have to have that knowledge and have that humility, and like if you ever never done construction, but find somebody who's done construction or done appraising, at least know kind of the trades, so that they can get the team the best deal for the investors in the team. At the end of the day, like the lower the cost, the better. And when you look at multifamily, it's really just its scale of single family, because you might have 100, you might have 1,000 units, and you have to go in and redo everything, right? But understanding how contractors work, if a general contractor has 10 crews, and you can keep 5 of his crews busy for the next 18 months or 2 years, that contractor is going to give you a better deal than just saying, hey, Austin, I've got 1 property this month and then 2 next month. So if you can guarantee that time, but also when you're doing those underwriting, you have to factor in that there will be a period of time when that money's not coming in for that unit.
Okay, that's awesome. And are you able to underwrite a lot of deals to see if they work?
I've underwritten probably almost 75 deals in the last month and a half, and one of them might work. So, but I mean, it's good experience in the sense of, the first time I actually wrote a deal, it took me like 2 hours. Now I can do one in 15 minutes, but then you understand the impact or at least I do, the more I've done, the impact of interest rates, the impact of the amortization loan, because, again, multifamily is just a combination of single family homes. But when you look at it, it's, like, would you pick a 15-year mortgage or 30-year mortgage, right? And it's the same thing now. Multifamily, it's typically a 10-year term, i.e., it will have a balloon payment, but it might amortize in 20 years. It might amortize in 25 years. I've seen as long as 40-year amortization. And there also might be an interest-only period where you're not paying down the debt at all, but you have that 2-year period or 3-year or whatever. And it's not like when you're buying your house with you and your significant other, the banks are going to say, if you say, oh, what are the rates? 6%? Oh, well, I want 5%. And they're like, well, you can pay points, but you're going to pay a lot of money to get that. Versus it's all about relationships. If you've been with this bank for your local bank for your entire life, and your parents were with it, all your relatives were with it, they might come and say, "Hey, we want to do another. We're not at our um, allocation of in a regional bank the amount of single family or multifamily homes that we want to be with." All right, and then you can negotiate. And the impact that that 30-year amortization has, I mean, it's the same thing as a car, right? Like, what can you afford on a 5-year or a 3-year loan or 7-year loan if you have to have that car? It's the same thing. That monthly payment can make or break a deal as well.
Okay. Yeah, that's great information. And you said you've underwritten 75 deals in the past
Yeah,
month?
month and a half. Yeah.
Wow. So it kind of seems like a lot of this is, you kind of have to find the motivation for it. How would you say that you find the motivation to go about doing
It's
this
my
all the time?
kids, right? I don't want to I've done a corporate job. I want to be my own boss. Um, I want to create that transgenerational wealth, but also I want to, be able to give back to my community, whether it's a word community, whether it's my local church, um, just the things that I truly care about and want to have an impact on. Those are all things that I want to do. And so each day when I wake up and I get to spend a little bit of time in the morning with my kids before they go to school, it's for them. It's, my wife currently has a W-2 job. I want her to come on board and be a full-time partner in the multifamily space with me, right? She balances her strengths or my weaknesses, or lesser strengths, and my strengths or her lesser strengths. And so we're a good team. We've remodeled or fixed and flipped several homes together, and so we're just trying to grow that dynamic. And then, my long-term goal also is I want to take, me in 10 years, the younger me, the me now, and bring those younger, hungry, multi future multifamily general partners under my wing and help grow them and have an impact of and strengthen the country through providing great jobs and great opportunities.
That's awesome. That's a great cause that you're doing it for. Now, are you looking for investors currently for
Yeah, I
doing
mean, I don't
deals?
currently have a deal, but I'm trying to, it's again, it all goes back to relationships. The people that become out accredited investors, they don't get their money by just giving away to people. And it takes time. Sometimes it takes hard work, being successful, selling to other companies. However, they got to that point, they're not, and they shouldn't just like give that away. But yes, I'm looking for investors. So when that deal comes along, if I know, hey, I've got $1 million or $1.5 million or 3 million, whatever that number is, it also changes the properties that I can look at. As when you look at, going back to reference to single family homes, non VA, non first time FHA homes, you have to put 10 to 20% down, or you're penalized with prepayment interest. Not prepayment, insurance that you pay, basically throwing money away because you don't have the down payment. Now in multifamily, you're looking at 65 to 75% is the amount that the bank will give you, or the credit agency that you go through. So you have to raise that 25 to 35% in order to make it happen. So yeah, like if you want to take down a 100-unit complex at a time, or 100 doors to use another lingo, you need to know, like that might impact the market that you're looking at. If they've got $3 million of investors' equity, who they say, hey, no matter what, we'll give you, if each person, I'll give you 50 and I'll give you 100, or however the numbers shake out, then that's 50,000 or 100,000. Then I can focus in on, hey, I'm looking for 100 units that are in the, say, 10 million to 15 million price range. So it kind of helps. And then once you have it under contract and you're going through the due diligence, it's less work because you already know you've got that capital raised. And so you can focus on making sure that you're checking every because right now the team is me with assistance from my wife, and I'm as I'm looking for partners as well that will add value. It just we can focus on other things, coming up with a big plan, identifying how we're going to get that, how we're going to, because the most important asset of us is our investors' capital, and we want to make sure that we never lose that money.
Yeah, that's a good plan. Uh, Greg, did you have any questions you wanted to ask?
Um, so I guess, Ben, what was the toughest lesson that you had to learn investing in multifamily?
You know, so I've never truly invested. I mean, I've never been the general partner side of the investment other than like capital through funds. So jumping into I think it just knowing myself and knowing why I'm getting into this, and then finding the right people. I mean, there's a lot of gurus out there that will sell you a course. That doesn't mean they're good, right? Like, and as you start searching in the algorithms, and the as you and Google, whether you Google something, you might start getting hit up for things. You're going to get a lot more Facebook ads or whatever social media platform you're on. You'll get that information. But just because somebody's been in the space and been successful doesn't mean that they're going to be good. Like I get deals from another multifamily um, partnership to be a JV on their deals, and having that network of multifamily operators throughout. You get to learn about other people's reputation that what you don't necessarily get to see. So like, oh, these two guys are all the finance side and they have no general contracting experience, and then you hear that when it comes to that, they just take the broker's word. And brokers are great people, but they don't always. I mean, their livelihood is selling that house or selling that multifamily unit, and so they might not have any experience, just like a multifamily team. So they're just they might be not necessarily maliciously putting stuff out there, but they might be putting information out that they're not actually an expert on, right? Like they might say, if for example, I spoke with one last week, and he said, "Oh, this one takes like $2,500 a unit for the value add, but it needed new appliances. It needed at a minimum painting, recabinets, all new flooring, and when you factor in $2,500 and say 1,500 to 1,800 of that's the new appliances, now you've got, let's say best case scenario, $1,000. Well, if the apartment is 600 square feet per, I don't know anyone that would that you could get um, buy the material, like say luxury vinyl plank for $1 a unit or $1 a square foot, and then have it installed for what's that, $400 left. So like 60 cents a square foot install. Like, and then by the way, you got to paint, and there's your door locks and all these other things that like the people don't always know, but they're trying to make the deal, and obviously, and then they might it's Reagan always said, trust but verify, right? Like, trust them that, hey, they've done their due diligence and they're an expert in the market that they're representing. But also you want to verify through yourself of like, okay, call some contractors. What's it actually going to cost in that area to paint? What's it going to cost to redo the floors? All those things. I think, just the single family home experience I've done and running big construction projects, I've had that experience, and so you can just figure it out. And then with the relationships, it's go to Rentler or this or CoStar or whatever is better in this market versus this market. But I think for me, I brought a previous experience, as I mentioned earlier. I was a good Beret in the Army, so I kind of look at the world through a different set of lenses than most other people. So before I actually start looking at apartment complexes, I start looking at the big picture. What's the economic drivers in a city? What's the growth? Is there a shortage? How, if we do go into this recession, is this going to be one of the quicker ones to come out of, or is it oversaturated with new construction, which will push the rents down, right? The basic supply and demand principles. There's a lot of different factors, and everyone has their approach to how they want to take it down. I think I go into it with a conservative mindset of, okay, worst case scenario, a broker might say we can raise at $200 a month. I'm going to look at it for $75 or $100 a month. Can this still work? Okay, the broker says it's going to be 3,000. Okay, let's factor in 5,000 just to make, kind of add that cushion, kind of plan for the worst and then hope for the best, right? And then utilize project management principles to come up with that timeline to, does this make sense? And, if I've got a 250 apartment complex, it's going to take substantially more time to do than a 100 unit or a 20 unit or a 12 unit or 4-plex or 8-plex. And then just factoring in those times and the impact of the downtime. So I think it just takes getting into and getting your feet wet and again, finding, like everything in life, finding mentors, getting that experience, putting yourself out there, going to meetups and social networking events and finding those people that are in your tribe.
That's great advice.
Yeah.
As we start to kind of wrap up here, Ben, you said you're looking for investors. What's the best way people can reach out to you? And if they're interested in either investing or just, getting to know you and working alongside
you? There's not a lot of Ben Batemans out there, but and my website's under development. So my website's not currently up, but you can reach out to me. Maybe we can put a link in this podcast, but it's Ben at lattilecapital.com. And Atlatl is a primitive, basically it's a leverage device used by Native American hunting tribes to affect their throwing ability, i.e. leverage, and their accuracy hunting with a primitive spear. But, that's what I see myself as. That's my strengths. I'm a hunter looking for deals and opportunities of things that I can find, buy, refinance, or rehab, retenant, refinance, repeat.
Okay. That's awesome. Yeah, we'll absolutely drop a link to that along with your social medias and to also your nonprofit. But it's been an absolute pleasure, Ben. Greg, did you have anything else?
No, I'm all set. Thanks
Awesome.
for coming on.
Yeah,
Ben.
no, I appreciate the opportunity. As I grow and learn and share the worlds, I appreciate this opportunity, and hopefully in the not too distant future, maybe I can come back on and talk about what it's like going through those processes, the underwriting, the due diligence, and actually closing and what it takes. So I appreciate the opportunity to spend some time with you all tonight.
Yeah, absolutely. Yeah, we would love to have you back on the show, and we'll definitely keep track of your journey and stay in touch. But this has been another episode of Life, Love, and the Pursuit of FI with your host, Austin Culp.
And Greg Gaskin.
And our guest star, Ben Bateman.
Thank you,
Thanks,
guys.
Ben.